Hola, buenas tardes, ¿me escuchan?
Buenas tardes, sí.
Buenas tardes, sí.
Buenas tardes.
Sí, Guille.
¿Me escuchan?
Sí, Guille.
Sí.
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 Listo. Creo que ya están los jueces listos y no sé si ya están ustedes listos para empezar.
Sí.
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 Ok,
Estamos listos.
listo. Ya, perdón, es que sí ha sido muchas cosas, muchos detallitos y la tecnología no ayuda. Entonces, a la hora que, si todos están listos, puedo yo tomar el tiempo. Ok. Ok, a la hora que ustedes estén listos, a la primera palabra cuento el reloj.
Claro, ya están viendo la pantalla, ¿cierto?
Sí.
Gracias. Okay, so greetings everyone, and thanks for being here. We are the team representing Instituto Politécnico Nacional, and we conducted a valuation for Vesta, a Mexican company competing in the industrial real estate sector. We issue a buy recommendation with a target price of 49.59 pesos, representing a 36% upside. Let us tell you the reasons that led us to this decision. So first of all, how does the company make money?
Well, Vesta has three kinds of industrial parts and buildings, which they lease to their clients. Automotive, logistics, and aeronautics are the most relevant sectors from its client portfolio, and 52% of its gross leasable area GLA matures by 2024. Vesta has 188 properties distributed among 15 states in Mexico, leading in the Valle region. With its current corporate strategy, Vesta Level 3, the company expects to increase its GLA 37% from 2019 to 2024. Their main clients have good credit ratings, and recently, they signed a big one, Coppel. But now, what is Vesta doing in terms of ESG?
Vesta has a long-term ESG commitment. It is part of Dow Jones Sustainability Index MIDA, and this year, it became the first Mexican real estate company to issue a sustainability-linked bond. Also, Vesta updated its internal social targets on El Espíritu de Vesta, promoting better social practices, and with it, the ethics code, its board has improved accountability and transparency. This has been reflected on a competitive ESG score given by Refinitiv, S&P Capital IQ, and a score based on a team's rubric. Vesta's environmental commitment became even more robust this year because they issue a sustainability-linked bond for $350 million. This bond has aligned KPIs in some specific matters. For example, certifying its building with LEED certifications. Vesta is committed with surrounding communities and education. For example, it has promoted programs with scholarships and resources. However, one of the challenges we detect is that although it has improved its total female employees on a company level, this has not been yet reflected on its board of directors, with only one woman as a full member. Finally, its board is comprised of members whose preparation and experience in the real estate industry improve Vesta's policies. An issue we observe is that there is a significant amount of insider holding, which may not be in line with Vesta's transparency guidelines. In general terms, Vesta has a leadership on ESG matters, with some areas of opportunity. Now, what is going on outside of Vesta?
Well, Mexico's economic growth is expected to improve, but with persistently high inflation. According to Banxico's private sector survey, Mexico's GDP is expected to grow 3.78% in the fourth quarter, but inflation looks far from Banxico's target. The United States is in a similar situation, with both rates hovering around 6%. The industrial real estate sector could be benefited as leases are often indexed to inflation rates. Likewise, it provides natural protection to investors in inflationary scenarios. The Fed has suggested leaving the idea of transitory inflation, so tapering is becoming more and more latent. This would lead to an appreciation in dollar and currency losses for those subsidiaries that have the peso as their base currency. On the other hand, interest rate hikes have begun. Mexico is expected to close the year with a target interest rate of 5.25%, which would mean higher loan prices for the sector. As for demand drivers, we observed three main ones. First, the recovery in jobs has led to an increased demand for industrial space, as it can be seen in the chart. Then, e-commerce has experienced a boom since the pandemic in 2020. This sector, together with logistics, is expected to demand 42% of the industrial land this year. And last but not least, USMCA and nearshoring makes Mexico an increasingly attractive country to invest in due to the possibility of maintaining a competitive position with the North American market. All of these factors point to a clearly favorable macroeconomic outlook for Vesta. But can Vesta face the challenges?
Let's take a look at the financial analysis, which is composed of 4 fundamental sections: liquidity, profitability, shareholders, and leverage. But first, we need to review the expansion strategy that Vesta has implemented since 2020, which is called Level 3. This operates with 85% of the company's income denominated in US dollars and the other 15% in Mexican pesos. This plan has allowed the company to increase its GLA levels, but also a reduction in its occupancy rate in 2020 and an increase in debt. Despite the economic recession in 2020, Vesta managed to play a good role by presenting an increase in its revenues. One of Vesta's strengths is its level of liquidity, which is not very common in this industry. A higher current ratio than its competitors and a positive net working capital shows a competitive advantage because they are able to meet their short-term obligations and to take advantage of new investment opportunities. Vesta shows a strong EBITDA margin, which reflects a good management by the company, that, compared to its peers, is the highest with 80%. In order to have a broader picture of the company's performance, a Dupont analysis was carried out. The results were that ROE, the average level of its peers, is to reach a level of 7.8%. Given its current expansion strategies over the last 5 years, Vesta's debt has increased from representing 26 to 43% in 2020. This has led to a constant growth in its investment property and therefore in its revenues. This means that Vesta can use all its resources for such investment and boosting its growth. It is necessary to talk about an aspect that may be negative for some investors, and that is that despite having a competitive dividend, it has a lack of consistent dividend payment policy due to its investment strategy. Therefore, this company is intended for investors who are looking for an organically growing company with a competitive dividend too. But are there any risks?
We identify different risks. However, let's talk about the main ones, which are the following. Rising interest rates, because with high interest rates in Mexico, Vesta could be less attractive in terms of dividend yields against its peers and fixed debt instruments. Also, inflation on the rise, because a series of upward adjustments in contracts may not be sustainable for some clients, intensifying termination risk, and electrical reform in Mexico. Because an increase in client costs could jeopardize their leases and make Vesta sustainable buildings less attractive. Finally, what is a rational price for Vesta?
Well, we followed a branded approach for this valuation, consisting of 3 methods with different weightings on the target price. First, a discounted cash flows with 50%, a relative valuation with 30%, and a net asset value with 20%. A dividend discount model was considered too. Nevertheless, as Vesta's focus on growth, it has a lack of a consistent dividend policy, which did not allow an accurate estimation through this approach. This outlined a price of 49.59 Mexican pesos, which represents a 36 potential upside. For the DCF model, we built projections for the FFO's next 5 years, matching the timelines of Vesta Level 3 expansion plan and its business cycles. We then discount these cash flows by estimating the weighted average cost of capital, following the capital asset pricing model, and considering 2 additional premiums. First, a country risk premium to capture the risk spread associated to an emerging economy such as Mexico, and a size premium, since Vesta is a small capitalization and growth company. To approach the terminal value of this model, we assume a perpetual growth rate which is in line with the economic joint, as seen in the table below. And finally, we conducted a sensitivity analysis to assess the impact of on certain outcomes that could happen on the valuation, bringing the 2 main drivers of it, WACC and perpetual growth rate. The most pessimistic scenario targets a price of 44.23 Mexican pesos, still significantly above current price. For the relative valuation, on the other hand, we took industrial real estate fibras to compare Vesta. They have similar opinion metrics and compete under the same conditions. So we chose EV to EBITDA as the standardization metric and took the median from the peers pool to compute an implicit price for the company. This model points out that Vesta is trading below its implicit price from the industry, which indicates there is an opportunity for profit according to current market conditions. Finally, net asset value and net asset value per share were computed. These models reflect the intrinsic value of Vesta based on its assets, and currently an attractive 30% discount to NAV is observed, and an acknowledgement from this gap from the market would represent an appreciation for the stock price, supporting our buy recommendation. So, in the end, is Vesta worth it?
Well, this is a snapshot of Vesta's main strengths. These are the reasons to issue a buy recommendation. Additionally, not only does Vesta have many strengths, it also has a moat. Being a C Corp leaves more room for reinvestment
1 minute.
and growth, a competitive advantage against fibras. These reasons make us believe this company can bring value to any investor willing to trust in it. We see Vesta as more than a fibra-like company. Thank you for listening. Now we'll be honored to answer any of your questions.
Okay, if may I begin? Let me address some concerns I have regarding why should I invest in Vesta and not in Fibra Prologis, for example. Fibra Prologis has been having a very good behavior. It's a very strong company. It's very similar in the market that Vesta is. And what could be the advantages or the benefits of Vesta against Fibra Prologis?
Well, it's an honor answer that question for me. Legal advantage is that they aren't obligated to pay dividends, which is why they can easily grow. And second, with high interest rate, fibras could be replaced by fixed instruments, while Vesta had advantage for the growth it can offer by having fixed interest rates. The third is Vesta has a hybrid profile. It may be a growth plus competitive dividend, and the last is and has an ESG leadership. It was the first real estate company to issue a sustainability-linked bond to ESG matters.
If you let me complement that answer.
Please, can I?
Sure, please go.
Well, we have to talk about the difference between fibras and Vesta, because we can find that principally the main difference is in their tax system. As well as fibras have a tax benefit, but by income taxes law, when fibras has to legal obligations as giving back 95% of its utilities and buying governmental bonds, Vesta has freedom to give back less dividends, but reinvest easily to grow faster. And that's advantage we can find.
Which can be portrayed in this graph. For example, what you can expect from this company is a company that grows, but also pays a very competitive dividend. For example, if you had invested 3 years ago on this company on November 1st, 2028, you would have had a CAGR of 19%, considering both dividends and the appreciation for the stock price. So this company would make a fine addition to any investment portfolio.
Okay.
Okay. Well, first of all, congrats all around. Pretty good job. So feel proud of being here. My first question has to do with why did you choose the different models? No, it's kind of explained on the presentation. No, and in specific regarding NAV, it doesn't prove to like a lot of a big differentiator at this point, given that the discount has been sustained for the last 5 years. No, and in terms of the multiple that you choose for comparison with the other industry, enterprise value EBITDA is usually not the most preferred among analysts for the real estate sector. No, so can you justify a bit on those two things, please?
Sure. Let me take that question, and thanks. Well, first of all, regarding to your last question, we chose EV to EBITDA multiple because we faced the challenge. Price to FFO is one of the most standard metrics to compare across real estate companies. However, this was an unfair comparison for Vesta due to two main factors. First, Vesta issued stock in 2021, which reduced significantly its FFO per share metric. Well, that's first of all a disadvantage for the company, and second, the FFO computation for Vesta is it diverges from the Fibras one. As my partners were saying before, this company has a different tax structure, so this company pays out more in taxes, so that makes the FFO to be a little bit lower than its peers. So that's the reason why we took the EV to EBITDA multiple. And well, regarding to the net asset value, which was your first question, yes, we can mention that we observe this premium. But however, what the market is expecting generally from a real estate company is to pay a fixed dividend. They see these kind of assets as fixed instruments. So as Vesta's dividend policy is yet not consolidated, perhaps the market price has been trading before net asset value. So an acknowledgement from the market would be for Vesta to implement a more stable dividend payment policy. So the maturity of this company would represent the close of this gap.
Okay. Good afternoon. I want to ask you, what do you suggest or propose to the management to get an upgrade in the credit rating of the company? Because the cost of capital is a key in the profitability of the company.
Yeah, well, I would like to answer that question. First of all, we need to talk about the management that Vesta have during the pandemic. Vesta took advantage of the drop in interest rates with the issuance of the green bond. They issued that $350 million to improve its profile without major amortizations until 2026. So Vesta already did something to improve its credit rating.
Also, we can count that the green bond was used to refinancing the debt with a near maturity. We can observe that there is a significant interest yield because this interest yield of the sustainability linked bond was 3.62%, and it's highly attractive because it is minor than the average yield. Also, Vesta is compromised with this part of ESG matters. Would you like to complement this question?
Yeah, talking more about the bond. This green bond seeks to meet sustainable development goal of industry, innovation, and infrastructure with the GLA's LEED certified key performance indicator. It is expected that 20% of the GLA will be certified by 2026, and in the long term, 30% by 2030. So they use its ESG leadership to refinance its debt and improve its credit rating.
And that part was used to build the scorecard of ESG matters. So we can't talk about this because the ESG scorecard, we evaluated the ESG components and then we took an average for this of the grades. The main KPIs we took for the team's rubric were the next one for environmental, electricity, water consumption, emissions, and policies as LEED certifications. Social, principally we observed the investment in social programs and proportion of employees and a compensation plan. And finally, the proportion of shares and the top 10 of shareholders.
Okay, thank you very much. What team are you? Sorry. For what?
Instituto Politécnico Nacional.
Okay,
Instituto Politécnico Nacional. Yeah.
Are you worried about the leverage? Because compared to most of the other companies, with some exceptions, it seems like pretty leveraged. And do you know the companies plan to reduce this level to more sustainable levels, or are you okay with that?
Thank you. I can take that question. Well, we have to remember that REIT are a sector with high percentage of debt. So, but we can see that Vesta is close to its peers. But we do see an advantage with Vesta, and that is that, for example, its coverage ratio is higher than its peers, being the mean of its peers 2.30% and Vesta's 3.10% in this coverage ratio. So it's higher, and it makes it an efficient company. They don't have any problems to face at least their short-term debt. Also, we can see this in their debt service coverage, then it's also highest to their peers. So we don't see this as a threat for Vesta. In fact, they are having more debt, but they also have a net profit margin.
A minute.
So it's an efficient company. Sorry.
Yeah, I would like to compliment and say that Vesta can raise money by other means, and they already did it. In April 2021, it made a public offering for $200 million, and they have an asset recycling strategy that is expected to result in $300 million. Also, Vesta has 300 million in cash reserve, so the leverage is not a problem for now.
Okay, and you don't think that the company does grow, but needs to invest a lot in capex to attract new clients, no? And most of the high margin businesses built to suit, no, compared to others, no, that are more open, especially for e-commerce, which is like a more flexible model compared to the main business of Vesta. Do you think they are well positioned to capture that, the e-commerce leg?
Time is over.
Time is over. Okay.
Oh, okay.
Congratulations.
Thanks.
But yes, thank you.
Congratulations, guys. Great job.
Thank you very much.
Thank you.
Thank you.
Thank you very much.
Thanks. Thank you very much for your time and for this opportunity.
Congratulations.
Thank you very much.
Thank you.
Thank you.
Shall we leave the room now?
Yes,
or-
please. Yes, please.
Okay, thank
Only
you very much.
only the students, please.
Okay.
Thank you.
Thank you very much,
Thank you.
everyone.
See you.
Cuando ustedes me indiquen, pasaré al grupo que sigue.
Yo creo que nada más bueno, sí, por mi parte nada más un momentito, por favor.
Sí,
Guille,
sí, no hay problema. Cuando ustedes me indiquen, tienen tiempo.
Recommendation for Vesta with a 44.78 Mexican pesos target price and an upside of 21%. There are three main factors that drive our recommendation and are underappreciated by the market: a strategy towards a bright future, new trends to maximize goals, and consistent inflation hedge. Sofia will now introduce the company.
Vesta is a real estate developer, possessor, and asset manager of industrial properties across Mexico. It provides with strategic locations with access to ports, airports, highways, and borders. Vesta has three main products: park to suit, build to suit, and inventory buildings. It has 189 properties with a 93.1% occupied stabilized portfolio. Vesta is completely responsible for their entire value chain, only with the exception of the construction link, where they have key suppliers in order to provide quality and competitive prices. Vesta has a very similar business model to Fibra's, only with the advantage of lacking Fibra's strict regulations in order to be able to reinvest their earnings into their business. Regarding Vesta's risk, our main concern is the perception that shareholders may have on the Mexican economy. Firstly, Mexican government political views could affect Vesta's value over time. Also, FX and commodities prices could affect Vesta's operational costs. In spite of that, these can be mitigated with strong risk management strategies and stable financial foundations. Also, Vesta's experienced board of directors knows how to mitigate these risks in order to help Vesta stay resilient to crisis, just as we saw in the pandemic, where they accumulated a 15.84% gain, outperforming almost all its Fibra competitors. Now, to elaborate further on our investment thesis, Ricardo.
We consider Vesta as a company that is consistently finding alternative ways to deliver value to shareholders. For instance, during the pandemic, Vesta has shown superior performance to peers. In fact, it had a steady occupancy and retention rates, profitable property investments, and investments with a robust capitalization rate. After achieving Vesta's 2020 strategy, the new company approach is called Vesta Level 3, in which the company states a future growth by strategic investments. Vesta is also expected to be considered a benchmark model in ESG matters due to its current and future sustainable actions. We estimate that the culmination of this strategy will increase the FFO to 20 cents per share and the net asset value to more than $3 per share. We believe Mexico to be an opportunity for current and possible clients of Vesta, which will benefit Vesta's contracts and occupancy rates. Nowadays, Mexico represents 15% of the US total imports, making us their biggest partner. There are factors that seem beneficial when locating in Mexico. For instance, Mexico offers superior IP protection to US companies, in addition to lower labor costs, and also a decrease in costs due to a short supply chain and existing FTA agreements. On the other hand, online shopping skyrocketed in 2020, and industrial real estate companies have played a crucial role in this tendency, since now companies require extra space for inventory and logistics. We can see Vesta already made its first move into e-commerce with the recent contracts with Coppel for more than 10 years. Lastly, the increase in inflation has raised concerns worldwide, and many investors are looking for the best financial instrument to protect them against inflation. We believe Vesta represents a good option due to its inflation hedge, and this can be confirmed by the outperformance of the cap rate of Vesta against the Udibono. As mentioned before, Vesta has major sustainable actions that will be disclosed by Deborah.
Vesta has an ESG score of 52 out of 100, 3 times larger than the industry's grade of 17. It impacts a sustainable development goals of the United Nations. Vesta is taking care of the environment by implementing a sustainable construction manual, measuring its impact before, during, and after every construction. It worries about the materials used, its consumption, and building maintenance. Last year, 11.10% of its GLA was LEED certified. With the level 3 strategy plus the covenants, it wants to reach a goal of 28% GLA by 2030. In the meantime, 95% of its portfolio in development is in process of certification. Vesta is thinking about everyone's well-being. Its commitment program focuses on education, inclusion, and community development. Its yearly investment is used to develop several social initiatives that benefit the community and stakeholders. Its Young Talents program recruits recent graduates to introduce them to the working world. It also offers training on human rights and women empowerment, in addition to its great concern on gender equity, having 41.1% female collaborators and increasing the percentage of women in directive and managing positions. Vesta wants to create sustainable relationships. Its contract have a green clause stating that tenants must disclose their energy, water, and waste consumption. Likewise, it is starting to audit its suppliers on ESG matters. Furthermore, its board of directors is composed by a chairman and 9 specialized members. 80% of them are independent. Most of them are men, but having only 1 female board member. We know the importance of understanding a company in a qualitative and a quantitative way. Emiliano will now show how our thesis is incorporated into our projections.
We project Vesta's revenues to grow at a CAGR of 10% over the next 5 years. Growth will be driven by industrial real estate expansion in Mexico. This is a result of nearshoring and e-commerce tendencies. Also, driven by Vesta's ability for efficient operation, expanding its GLA and maintaining a constant occupancy rate. We also expect Vesta to remain having stable rental prices, growing at inflation pace only, which will further support its revenue growth. On the other hand, we forecast Vesta will maintain its current average gross and net margins for the next 5 years. Historically, Vesta has obtained superior profitability compared to peers. We predict this to continue, resulting in favorable shareholder returns, with EPS growing at 16% CAGR between 2020 and 2026. We therefore expect Vesta to increase its dividend payout, reaching $0.15 per share in 2026. Vesta has maintained a healthy balance sheet, achieving a 63% average cash revenue ratio over the last 5 years, which we consider as a high ability to generate cash from its operations. The cash lift in 2021 with the company's stock issuance and green bond emission will make its level 3 strategy possible. We also project CapEx to rise as the company enters this high investing growth period, allowed by the cash lift previously mentioned. Vesta has maintained a net debt EBITDA ratio of 5.3 in the last 5 years, and we estimate an average 4.9 ratio between 2021 and 2026, which is one of the company's main objectives for the long term. Also, Vesta has maintained a slightly superior coverage ratio compared to its peers, and we believe the ratio will remain within this range in the forecasted years. Now, Jerónimo will elaborate on the valuation methodology used.
Thank you, Emiliano. We issued a buy recommendation for Vesta based on a weighted average of the resulting prices in a DFFO model, a net asset value per share valuation, and a relative valuation. We decided to use a DFFO model due to its accurate interpretation by concentrating on the company's main leasing activities, which the market has undervalued. Finally, we estimated a WACC of 8.75% and a perpetuity rate of 2.7%. We also decided to include the net asset value of the company per share in our valuation to show the evident discount in which the share price currently trades. To calculate this method, we took into account the expected GLA growth of 2021, predicted end of the year liquid assets, and the current value of Vesta's debt. This valuation shows a 37% upside and a potential growth when the level 3 strategy starts development. To complement these two analyses, we also use Vesta's enterprise value over their net asset value and FFO multiples and compared it with Mexican fibras. Results showed Vesta's superiority in both asset management and growth strategy, making Vesta a must-have in any investment portfolio. We also decided to make a sensitivity analysis to see the resulting price in different stress scenarios of the WACC. As we can see, depending on the rising terminal growth, scenarios go from good to extremely bullish in 68% of 1 million simulated logarithmic Monte Carlo scenarios, and an Arimax model taking into account the GLA growth, inflation, and the IPC market. Final calculations yielded a 44 pesos and 78 cents price. That's a 21% upside, showing us how Vesta is constructing a brighter future. Thank you, and we will now take your questions.
Okay, thank you guys for your presentation. Good job. I have a couple of questions, and it's regarding the financial situation of the company. In your model, you are making a scenario or sensitivity analysis of the occupancy rate. It goes from 90% to 96. I don't know, that was the numbers I saw. The current occupancy rate is 90%. So why didn't you make a scenario analysis in which the occupancy rate is lower than 90%? Because 90% is the current situation. Even though 90%, it seems like a low number for this kind of companies. I would have expected, I don't know, like maybe 93, 94%. I don't know if I recall properly, Prologis is around 94%. So my first question is about this scenario that you put in your presentation that is goes from 90 to 90, I don't know, 97 or the kind. Why didn't you consider a lower occupancy rate?
Thank you. Thank you for your question. Yes, we have seen over this new quarter, in the third quarter, that occupancy rates have been growing, and it's the way that are going to be growing lately due to the trends of nearshoring and e-commerce. We have seen that in the north region of Mexico, we have seen a stable occupancy rate of 99 from the 96% that it was in 2020. So it has a growth of 3%. And also in Bahia regions and in central regions, they are at 91%, which grew both 1%. So we have seen this trend of upcoming growing stable occupancy rates. Also, as we have seen these new trends of having new warehouses and more space. So we don't believe that this is going to be lower. We actually believe that Vesta is going to have growing occupancy rates, and we wanted to have those scenarios because we don't believe that it's going to be lower.
Another question about this. Historically, the occupancy rate is about?
Yeah, historically, the occupancy rate is about 93 to 95.
Okay, and 90% it was from COVID?
Yes, it was related to that, and it has recovered in these last few quarters.
Okay, thank you.
Okay, I was going to ask you, first, congratulations. Regarding the cap rate, you compared to this, I didn't see any comparison to the other REITs, and also wanted to hear if you had the chance to also check the competitive landscape internationally. How does it compare to US REITs?
Yes, I can take that question. So first of all, Yes, we compare it to the US rates. We know that US rates are obligated to give 90% of the revenue of their net income to their investors, while Vesta has only the 75% dividend between their investors. So yeah, we made the comparison with Fibras because we found it more relevant to see a closer to home comparison, and we think that it shows a more relevant situation of what Mexican real estate market is right now.
In addition to that, we know we did this NAV per share evaluation with the historical Vestas cap rate, but we also did it with the average of the industry of Fibras. So we did see the cap rates from all the competitors, but we didn't present it right now because we thought that we had a more accurate view of the valuation if we use Vestas historical cap rate.
Okay, thank you.
Good afternoon. Congratulations for your work. I want to ask you that we are in the beginning of a normalization of the global monetary policies by the major central banks. What do you believe that could be the effect in the business of the company and in the price in the future of the shares?
Yeah, I can take that one. So we already know that Vestas has 83% of their income in US dollars. So they have that natural cover. Yes, they are exposed when they transfer the money to Mexican pesos, since the exchange rate may fluctuate between the time they receive the rent and they present it in their results. It may be affected, but having that high percentage in dollar denominated currency, they have that protection from higher spikes in the peso dollar price, like we saw in the last weeks. So right now, I think they have a great position.
Okay, this is one of the main effects, no? The exchange rate in the incomes. And in the cost of capital, what are you thinking about?
Oh, sorry, can you repeat that, please? We had some audio issues.
Okay, in the normalization of the monetary policies in the major central banks of the world, what will happen with the cost of capital of the company and with the price of the shares in the future?
Yeah, I can take that. That's an excellent question, actually. Well, since all of its debt is denominated in US dollars and constituted in the United States, we are forecasting a hike rate in the US, and that would affect the WACC, since that would increase, and that would probably be an affection in the stock price to the downside.
Okay, thank you.
Sustain the growth that they're planning. This strategy, the level 3 strategy, takes into consideration a huge leverage, I might say, and it's already very high. So how is the company going to finance all the growth that he's looking?
Thank you. I can take that. Well, first, with the green bond emission that the company just made this year, and with the follow-on stock emissions that they did also this year, the company had enough cash to sustain the capex needed to to in compliance with the level 3 strategy that we just saw in this presentation, and around 2023, the company will need to issue another bond to continue with this capex rate and with this capex piece.
Yes, it's clear that the company is going to go into the bond markets or loans or whatever to finance the capex that is needed. But this capex is going to take a while until it gives some EBITDA. So this is going to deteriorate the credit rate of the company because it's going to take more debt into its balance sheet. So that is kind of concern, isn't it? Because all the bet is on e-commerce. That e-commerce, of course, is growing, nearshoring, etc. But up until certain levels, because there's a huge there's a huge competition in this arena. So I'm not quite sure if I'm buying the idea of taking this leverage and if they are going to take this net EBITDA ratio lower than 4 times.
1 minute.
Yeah, well, we've seen that, as already mentioned, the net debt EBITDA is projected to decrease in the forecasted years, maintaining in the company's objectives, which is between 4.5 and 5.5. We're forecasting the average net debt to EBITDA through 2021 to 2026 in 4.9. And we are estimating a superior coverage ratio. So we believe the company has the liquidity to keep counting with its obligations. And we don't see any relevant issue or affectation in Vesta through this high investing growth period.
In addition to that, I can say that Vesta's main concern of their debt is going to be until 2031. So it doesn't have any like short-term big obligations with their debt, and it actually has their bond until 2031. And it is a good overview of what we're seeing in rights. So I believe that their debt and their obligations they are well aware of them, and they know, and they have been projecting, and they have a well-managed strategy and stable foundations in order to be able to meet their obligations.
Time.
Thank you.
Thank you. Congratulations.
Thank you very much for the opportunities.
Please, students can leave the room, please.
Yes, for sure. Thank you.
Nice job.
Thank you.
Thank you.
Guille, Ana, Cecilia, Rodrigo, Ernesto.
Upside.
Vesta is a publicly traded Mexican company that develops, operates, and leases industrial buildings and distribution centers with a GLA gross leasable area of 2.9 million square meters. Their top quality properties are located within 3 strategical regions, Bajío, North, and Central. Vesta is therefore an asset management firm with a development vehicle for growth due to a strong product base. Said products are the inventory buildings, the build-to-suit, and the park-to-suit. Their culture relies on having the best eco-efficient standards, having a major impact on Vesta's net asset value with 1 year percentage change of 28.3. All of this is aligned with Vesta's Level 3 strategy, which consists of a commitment program, ESG operational indicators, and sustainable construction and building certifications, by default contributing to a more sustainable future. Vesta is an industry leader in terms of ESG, committed with their internal targets at every level through 3 main pillars. For the first being environment, Vesta has systems in place to manage energy, water, waste, and emissions. Each of these categories aim to improve performance in pre-established targets. Responsible investment, as the second pillar, they seek to improve the quality of life in the communities surrounding their properties through investments in education, inclusion, and community development. Also, finally, in terms of integrity and governance, Vesta has a solid structure that ensures confidence for shareholders. The board of directors and the management team is composed of people with considerable experience in the industrial real estate business. Based on the Rationale methodology, we estimated our own ESG score, arriving at the value of 71.3, in our opinion, reflecting Vesta's capacity in handling ESG issues. To complement our ESG analysis, based on the sustainability score by Standard & Poor's, we can clearly identify that Vesta is an industry pioneer in the ESG with a score of 52. When compared to its peers, with an average score of 47, Vesta outperforms. Mitsuo will now elaborate more on our investment thesis.
We believe the market is underappreciating the following three main catalysts for Vesta: e-commerce and logistics expansion, attractive opportunities for nearshoring in Mexico, and a strong tenant base and industry diversification. The first key catalyst has shown enormous potential. We expect the e-commerce and logistics industry in Mexico to grow at a CAGR of 39%, representing a total growth of 87% within the next 5 years. This is a huge opportunity for Vesta, since the current e-commerce and logistics portfolio has been increasing rapidly from 2.6% to 4.7% in the last year. This is strongly related to the second key catalyst, nearshoring, since Mexico has 13 trade agreements with 50 different countries. This maximizes the following competitive advantages: a strategic location, competitive labor cost, and low trade tariffs. Right now, all of these are worldwide competitive, even against China. Furthermore, it is important to mention that international trade accounts for 78% of Mexico's GDP. This directly correlates with the last main driver, a strong tenant base and industry diversification. Vesta's current portfolio is exceptionally diversified because none of its existing tenants account for more than 6% of its rental income. The state of the portfolio is also modernized in the terms of SDG, creating important strategic connections with their current and potential new clients, connecting the dots with Vesta ESG strategy aforementioned. Now, we will show you how our key catalyst and investment thesis is reflected in our financial projections and modeling.
When talking about Vesta's revenue, it is important to consider that 84% of the rental income is denominated in US dollars. We project Vesta's revenue to grow at a CAGR of 12% over the next 5 years. This growth will be driven by their Level 3 strategy, their growth in their GLA, and the three key catalysts: a strong tenant base, e-commerce and logistics expansion, and attractive opportunities for nearshoring in Mexico. We forecast stability on their margins since Vesta has been able to do so for 10 years in a row, having better EBITDA margin and gross margin than its peers. Their key to achieving this has been keeping their operating expenses low at an average of 18.3% of their revenue. Vesta's debt is well distributed across different maturities with an average of 7.1 years and a 4.5% average interest rate, highlighting that 100% of Vesta's debt is fixed rate in US dollars. Vesta has a main objective when it comes to debt, maintaining a net debt to EBITDA below 5.5. Vesta has achieved this goal, getting this ratio to a level of 4.2. In addition to their net debt to EBITDA, Vesta's total debt equity ratio of 66.3% confirms a healthy debt level. We project CapEx to expand as the company grows, as a result from the flexibility for capital allocation that Vesta has for not being a REIT. Vesta uses this freedom to grow faster than its peers who have to pay greater dividends. Historically, Vesta has obtained better profitability compared to its peers, with a ROE 1.7% greater. We predict this to continue, resulting in favorable shareholder returns.
We therefore restate our buy recommendation with a robust valuation, consisting 80% on a DCF model and 20% on a DCM model. Furthermore, we conducted a relative valuation and a Monte Carlo simulation to give a more solid ground to our analysis. As you can see, every model yields a target price higher than the current share price, which indicates that the market is undervaluing Vesta's future growth potential and value delivery. For our DCF, we arrive at a 1-year target price of 47.8, representing a 34.8% upside, considering the WACC of 7.2% and a growth rate of 7.4%, which is aligned with Vesta's vision, the Level 3 strategy, and accounts for accelerated yet stable growth projected for the following years. Finally, we're proposing a conservative 2% terminal growth, a value that encapsulates consistent growth across Mexican industrial sectors, consolidation of new markets such as e-commerce, and real GDP values globally. As we know this is a sensible variable, in this chart we can see how it's clear that a more conservative outlook still lets Vesta return value, and unlocks pricing potential way above our target price with a positive panorama. We supplement our DCF with a DDM, considering the same cost of equity and incorporating more accurate measures for growth that account for the way that Vesta chooses to pay dividends, always with liberty to allocate capital and ensure higher growth than its peers, arriving at the value of 41.8, representing an 18% upside. Given that the multiples do not account for business quality and considering Vesta's unique structure as a non-rate firm, we consider that Vesta is not entirely comparable to other industrial rates. Therefore, we do not include a relative valuation into our target price, even though we found out that the market is undervaluing Vesta against its closest peers. For our Monte Carlo simulation, we ran 100,000 possible scenarios, stressing the variables WACC, growth rate, and stable growth rate. We incorporated this model into a bull-bear case scenario analysis. For the bull case, we found a 30% probability to arrive at the price of 60 or above. And for the bear case, we found an incredible 20% probability to fall at the price of 32. We consider this scenario to be highly unlikely and unrealistic, and the numbers prove our beliefs.
We identify macro risks such as US interest rates and tapering, in addition to Mexico's increased country risk. Also, unsuccessful acquisition integration and customer payment default as the main risks. Customer payment default can be mitigated by high credit rating clients and industry diversification. Unsuccessful acquisition integration can be mitigated by pre-acquisition insight and rigorous portfolio management committee decision-making. And finally, macro risk can be mitigated by fixed rate debt and long-term leases. The other risks were either low probability or low impact. We therefore restate our buy recommendation based on Vesta's e-commerce expansion, nearshoring opportunities, and strong tenant base. For investors looking for a solid bet, Vesta is a win. Thank you. I will now take your questions.
Okay, thank you guys for the presentation. Good job. Can you go back to the slide on the financial slide on CapEx, please? That's it. Why is the CapEx going down from 17 to 20, and why it is growing at that fast pace? Is this a feasible growth for the CapEx? But because one thing is that the company decides that it wants to profit from e-commerce, nearshoring, etc. But there's a lot of competition in this market. So you have Fibras, you have Prologis that is making huge investments, and it's a direct competitor. So I'm not quite sure if these CapEx projections are going to be sustained. And if sustained, how is the company planning to fund this CapEx?
I'll take it. Ana Cecilia, thank you for your question. And first of all, the CapEx growth for Vesta has been decreasing in the last years since the company is getting to maturity. But since they've been planning on this level 3 strategy, they are going to expand on their CapEx. So it is going to be sustainable growth because of our 3 main catalysts, and also because they are growing on GLA.
Yes, they're growing. Sorry, they are growing on the GLA, of course, but is this a sustainable growth? The company is not only deciding, I decide to grow. Yes, of course. And there are some drivers because you have e-commerce, you have nearshoring, and it seems that this market is going up. But the company can make this CapEx and fund and maintain good credit ratings.
Also, I want to add that right now, the CapEx average for Vesta is between 150 and 170. So as you can see, the numbers in our CapEx projections is just between those numbers. So we believe that is just an objective projection for CapEx.
Okay,
To complement this answer, we can see that Vesta has a lot of big and very competitive peers. Ricardo, can you put the slide 51, please? What we will see is that, yes, indeed, other peers have e-commerce and logistics presence on the regions. But the thing is that Vesta is starting to implement this into this section. Right now, Vesta is not the biggest asset management of industrial parks, but as you can see, only 3 of the 5 peers selected have e-commerce presence. This directly correlates what Vesta did in 2016, which they included a lot and heavily into the automotive industry. Right now, it represents 24% of their portfolio. As we said, the portfolio represents 2.6% as the last year. Right now, it's 4.6%. As the third quarter releases, the investor relation team published a new acquisition with Couple, which implements and confirms this trend that Vesta is going directly through that way.
Thank you.
Okay, I will follow up with what you just mentioned regarding the automotive sector. What's your stance regarding, given the subsidies that the US government has announced regarding electric vehicles, Americans will favor buying electric cars in the years to come. And roughly a quarter of Vesta's tenants are related to the auto industry. So I didn't see this mentioned in the risk. And how do you think Vesta is preparing to capture this energy transition trend going forward? Thank you.
Yeah, I would like to answer that. So according to the metrics we shown before, can you turn, please, Ricardo, to the business description part? Is the number 3. Thank you. So we are turning more optimistic on the Bajío region because for years it has been underperforming, and as you can see, the Bajío region has the 48% as it is shown, and the aerospace and the automobile manufacturing activity in the Bajío is gradually improving, and recent data from the INEGI shows official data that the machinery and the equipment imports supports a more optimistic view.
Yeah, but at the end, for Americans to get a subsidy, they will need to buy a car that is mainly done in the US. So Mexico is not favored in that regard, and that's why the sector overall in Mexico is worried, that the auto industry is going to be hit by that. So I didn't quite got the...
Yeah, thank you. I would like to add something to complement my answer. So, as we know that Vesta majors of Vesta's clients are international clients, we believe that Mexico has a better position than China, who is we are better positioned near to the US against China, and so we believe that Mexico has a very unique geographic position to actually to compete against China in terms of new customers.
Yes, also to complement this answer, we can see, Vesta has a lot of high profile and high quality tenants, which 4 of the 10 leading tenants are from the automotive industry. Can you put the slide 51, please, Ricardo? Well, right now, the automotive industry represents 24.2%, which has a lot and several brands, such as Nissan, LSR, CR, which make components to these cars. So we consider this is a strong point to mention to Vesta, because the renewal rate is around 93.1%, which means it's very hard to these companies to leave Vesta. So this maintains the strength that Vesta has with their current clients, being part for this new and innovative point of view of the new electric cars that are incoming into Mexico and the world that export the cars. Yeah.
Good afternoon. Congratulations for your presentation. What would you could propose to the management to improve or to get an upgrade in the credit ratings?
Yeah, we're gonna, thank you for your question, Ernesto. We're looking for the slide.
Yes, I know.
I think the slide is at the bottom.
Well, our recommendation we can issue to the management to get better qualifications on the rating is that the debt that Vesta has needs to be, well, it's not a risk that Vesta has some of the debt in dollars, because 84% of the income is issued in dollars. So this favors Vesta. So what Vesta needs to do and has been implementing is that right now Vesta doesn't have any variable rate on their current debt. So all the debt is currently with a fixed rate. So Vesta needs to keep maintaining this kind of behavior to get a better qualification for the market to bring an upside into their current rating.
Okay. What do you believe that could be the impact in the company and in the price shares about the normalization of the monetary policy in USA and in the world, no? In the major central banks in the future, in the near years?
Yeah, thank you, Ernesto, for your question. Well, first of all, Vesta has a fixed rate debt and it's very hard for Vesta to lose that position and that credit rating that it has. And also between the macro risks, Vesta has long-term leases. So in order to lose that competitive position, with its peers or Vesta itself, it's very hard because of the long-term leases that it has and the strong tenant position.
Plus, it is well known that the banks may like bring higher the interest rates, so it doesn't affect Vesta because Vesta has their main income in United States dollars and they pay their debt or even the cost in pesos. So even if the exchange rate goes up, Vesta will benefit from this.
Thank you. Mitchell.
Time.
Okay.
Congratulations. I will take a picture of the team and all the participants. 1, 2, 3. Thank you.
Thank you very much.
Thank you very much.
Thank you.
Thank you very much for your time.
Building innovative and sustainable industrial real estate in Mexico. We greet you from Tecnológico de Monterrey, Campus Guadalajara. We issue a buy recommendation on Corporación Inmobiliaria Vesta with a target price of 43.45 pesos and an 18% upside based on our DCF model, forecasting a 10.8% CAGR on revenue and 14.5% on adjusted FFO. Our recommendation is sustained by 4 catalyzers: an exceptional tenant base that provides a stable source of income, industrial growth sustained by structural trends, ESG as differentiating factor for a more sustainable tenant portfolio, and management with proven track record set to deliver new growth strategy.
Vesta is a leading industrial real estate company. Its main activities are the development, management, and lease of 189 industrial buildings located in 3 Mexican regions: North, Bajío, and Central. Most of its revenue is generated by the Bajío and North regions with 46% and 33% respectively. Its portfolio is segmented in 36% of GLA for logistics and 64% for manufacturing.
Vesta's tenant base is composed by mostly blue-chip tenants, concentrated in the automotive sector, in which it is expected that 30% of new listings will be focused, and in the logistics industry, where Vesta is capitalizing e-commerce growth, expecting to increase from 4% to 10% of its GLA in next years, either with new tenants or by building additional capacity for its key tenant, Mercado Libre, Latin America e-commerce MVP.
I'm sorry, Julio, we can't hear you, so I'll take over. Don't worry.
Mexico, ¿me escuchan?
Oh, yeah, perfect.
Mexico is the largest industrial real estate market in Latin America with more than 800 million square feet of industrial leased land. At the same time, it is one of the world's top manufacturing sectors, ranking fourth as automotive exporter. Additionally, the country connects more than 1.3 billion consumers, equivalent to 60% of world's GDP.
We have identified two main trends that may accelerate the real estate industry and Mexico could capitalize. First, Mexico is the second largest e-commerce market in Latin America, following Brazil, growing 41.8% annually for the last 6 years and forecast to grow by 226% in the next 5. Second, Mexico keeps the approach of being the promised land for nearshoring, as American companies are moving out their operations from Asia, looking to escape from the current supply chain disruption. The biggest players in the Mexican industrial real estate sector that are set to benefit from these tailwinds are Funo, Prologis, Terrafina, Macquarie, and our case of study, Vesta.
Investors are shifting towards sustainability as $88 billion are forecasted to be invested worldwide in ESG. Vesta is capitalizing this opportunity by being part of the S&P BMV Total Mexico ESG Index and the Dow Jones Sustainability Index, and by having a higher S&P ESG score than the industry. We perform an ESG materiality analysis to know the affectation in profitability by Vesta's ESG standards. The results were, Vesta is well ahead of the industry average in environmental responsibility. However, improvement is needed. If compared with Funa Fibra PL, Vesta's score underperforms since they are not achieving its electrical and water management targets. Social is Vesta's strength. Companies' projects as its COVID relief are seen as positive by the market. By creating stakeholder and philanthropic engagement, this assumption is confirmed in the material factors where the company score is ahead of the industry average. Vesta's top management and governance is one of the industry standards. Management diversity and alignment of interest has provided superior performance in its governance material factor. Vesta is better in 95% of its material factors compared with the industry, which means that the company ESG standards have a highly positive affectation in its profitability. Material factor improvement means better returns, less risk exposure, and higher stock prices. Vesta aims to become the leader in ESG, and they are going in the right direction to achieve it.
From 2015 to 2019, Vesta successfully executed their Vesta 2020 vision of an aggressive expansion, delivering 95% of its objectives, which can be seen in the slide, capitalizing the opportunity to expand when the industrial sector outperformed the economy. Let us review their achievements. Total revenue grew 16% annually, driven by a 4% CAGR on rent per square feet and a 10% CAGR on its leased portfolio. Vesta has kept the momentum, outperforming peers by growing revenues 12.6% annually for the last 5 years versus an average of 9.8%. It is also the 5th biggest developer by portfolio size. However, it has outperformed peers in terms of GLA growth for the last 5 years, growing by a 9.3% CAGR versus a peer average of 5%. Clearly, the expansion strategy has paid off. However, a significant area of opportunity are its occupancy rates. Growth came with the cost of underperforming on this, with occupancy at 92.8% last quarter versus industry average of 95%.
Vesta is now a more mature company, and management has shifted focus with its new Vesta Level 3 strategy. Its plans are diversify the portfolio into the logistics sector, acquire new blue chip tenants, shift focus on margin improvement and shareholder returns, and become an ESG benchmark for the industry.
Vesta enjoys the highest operating margins in the industry when compared to peers. Even as Vesta aggressively increased its growth, both NOI margin and EBITDA consistently improved, with NOI margin close to 96% and EBITDA close to 84%, both metrics well above peer averages. Vesta is a winner in terms of efficiency, resulting in superior returns, with a current return of equity of 13.1% above peer average of 11.7% and above its cost of equity. A return of capital of 3.7% consistent with peer average, but below current WACC, as ROIC does not take into consideration capital gain on properties.
Turning to our valuation forecast, we expect rental income to grow at a CAGR of 10.88% for the next 5 years. Growth drivers are the positive nearshoring industrial trend, increasing demand for logistics by the e-commerce industry, the strategic focus on blue chip tenants, season management focused on this new strategic growth. NOI margin is expected to gradually recover to pre-pandemic levels and beyond, increasing to 97% by 2026, with EBITDA expected to increase sequentially to 96%. Key drivers here are the 2020 headwind recovery of 100 basis points on EBITDA, increased operating scale, a portfolio occupancy recovery and consolidation into 96%, and Vesta Level 3 focused on profitability.
We issue a buy recommendation for Vesta based on our 5-year DCF analysis. We use a 10.42% discount rate, which accurately represents the company's risk, and a terminal growth rate of 3% based on historical GDP growth. The target price obtained is 43.5 pesos, which means a 17.74% upside potential. This valuation was used as our official target price. However, to back up our valuation, we also performed a dividend discount model, where we obtain a target price of 48.74 pesos, representing a 31.91% upside, and a net asset value model with a 42.76 target price and a 15.72% upside potential. These two models provided us higher security on our DCF model target and trend being accurate, which has been proven right, as Vesta's stock price has grown 3.5% since the delivery of our research, leaving almost 14% expected upside in the coming months.
We also conduct a bull and bear analysis changing GLA growth, occupancy rates, rent per square feet, and profitability margins, depending on e-commerce growth and Vesta's ability to accomplish its growth strategy and ESG goals. In our bull case, we arrived at a 27.36% upside potential, and in our bear case, the stock price will lose 6.29%. However, the risk-return relationship is skewed to the positive side. Therefore, buying Vesta is a no-brainer.
The rising interest rates is the most probable investment risk that may affect Vesta stock price. The mitigating factors are that Vesta is currently trading at sub-valuation levels and the company is focused on long-term growth, thus providing the best value to its investors in the future.
1 minute.
We therefore restate our buy recommendation based on our 4 investment cornerstones: high quality tenant base, trends on the industrial growth environment, ESG as a differentiating factor, and management proven track record, which will have a catalyzer effect in its stock price in the future. And that is why in Vesta we invest. Thank you, and now we will take your questions.
Thank you, guys. Good presentation, good job. I would like to know if you have a chance to discuss with the company about the COVID effect, how the company managed the pandemic, the occupancy rate, the renewals, retention rates, etc. Or did they have to give some concessions to its tenants in order to retain, or if there was any tenant with problems and they have to make some restructuring on the payments? Do you have the chance to discuss with the company these issues?
Thank you for the question. We didn't actually get the chance to directly talk to them, but we probably read like 5 years into the past, their trimester quarter reports, and they do mention it. The first thing they did, or probably the main thing that happened, they did give like rent. They gave more time to some tenants. They deferred some rents in order to assist some of the tenants that did ask for some help in the rent payments. So in the year, the accounts receivable did increase significantly. Also, another account that really increased was an account that takes in rents that are in risk of not be getting paid. But in the end, you know, we're already in Q3 of 2021, and probably in Q1 of 2021, they already reported that most of those referrals were already paid. So really, that was one of the first things we saw on our analysis and our investigation. Occupancy also dropped in some regions. The central region, which also encompasses part of the south, did have a higher slowdown and some decrease in rental income and in occupancy, but it since has regained some momentum, some increase, and it's also almost in 2019 levels. So that was probably one of the main things that happened for the tenants and their rental income in 2020. There was, I would say, a couple of tenants that did fail and ceased to rent with Vesta, but it wasn't really significant to the overall company, which is, you know, like I think close to 35 million square feet of GLA. Right?
Yes, to follow up Alex's answer, can we go to the slide of operative risk, please?
Yes, so we did prepare some further slides in case of additional questions.
No, actually the external risk, please. Here we can see the risk number 3, that the COVID-19 could have material affectation to Vesta's clients and the company's operating results. But what Vesta did was to give payment referral grants to its tenants, which accounted for $5.5 million. And they recovered that amount, the 84% of the amount, in early 2021. And from September 2020, then 95% of Vesta's tenants have reached their per-pandemic operational levels. So this means that the Vesta does not affect high affectation by COVID-19 risks.
Okay, thank you.
Thank you.
Okay, my question has to do regarding, do you foresee at some point in time that investors actually get a juicy dividend? Revenues have been growing around 10%, CapEx is expected to grow more than 20%, and that has been more or less the story. Do you foresee a point where things stabilize and investors get a more decent dividend?
That's a good. Oh, I'm sorry. Go ahead, Julio.
Yes, that's a good question. Just to answer, since Vesta is not a rate, they're not like obligated to give the dividend, the percentage of dividend. However, this is part of the strategy of the company that is for other type of investors, value investors for the future. So they say that they have a policy dividend of giving up to 75% of the funds from operation. So we believe that since the level 3 strategy is based on profitability, we will see in the future that the dividend will tend to increase to reach this dividend policy they have.
Okay, thank you. And congratulations.
Okay, good afternoon. Congratulations for your presentation. What do you believe that is a better model for this kind of real estate projects or business? FIBRA or industrial rates, or the model of Vesta?
I think that answering that question, I think that it depends. It really depends on the investor and what is the investor seeking. Because if you are seeking like for a current payments quarterly, you will like a rate because the dividend will be higher than the structure of Vesta. However, as I previously mentioned, I think that a value investor that looks for the future and have a confidence on the company's management and on the strong balance sheet, I think that Vesta will probably be a better investment for them. I think that it depends.
Okay, thank you. Do you believe that the electricity reform that was sent to the Congress for the president in Mexico could affect the market or the business lines of the company in the future if this reform will be approved?
Yes, thank you for the question. We believe that it will affect, but it will affect not only Vesta, it will affect the peers, it will affect the tenants, as all of the market needs to make changes in the policies they have, because this reform will affect also the Mexican investment for external investors. So yes, we believe that it will have an affectation for Vesta, but not only for them.
Okay. What do you think that could be the impact in the company of the normalization of the monetary policies of the major central banks around the world?
Well, it may affect the inflation of all businesses and products sold, but Vesta has, like we said in the presentation, blue chip companies, which means that the rent payments as tenants, rent payments are key for keeping its business running. We believe that it will not have that much affectation to Vesta.
Just to add some to the answer, the monetary policy now is like increasing the rates, and we know that increasing rates it will like compete with real estate because are similar investments. So I think that it will like investment will require more return to this type of real estate. However, we believe that since Vesta has the new objective of profitability, we think that increasing the dividend will like offset this risk.
Okay, thank you. You also mentioned that the higher interest rate could be a higher risk, no, for the company.
Yes, it was seen as like risk for the stock market, where if the interest rates rise in the future, some investors will take its investments in the whole Mexican stock market and take them to a more secure investment, which is these interest rates. But we believe that as Vesta is currently trading at subvaluation levels, this will provide the investor the opportunity to buy the stock cheaper than it is as of now.
Yeah, so it's more of a matter of taking into consideration just the risk appetite that investors may have to different instruments. So right now, the debt market is not really very attractive, so risk appetite can increase. This can be very positive for variable instruments like Vesta, for example. So we do believe that it's a scenario we have to take into consideration, that we may see some corrections on the short term regarding valuation, regarding prices. But in the end, having a company which is completely focused on the long term, right? It's a developer, not a dividend giver. We do think that's an advantage.
Thank you very much.
Thank you.
Time.
Okay.
Congratulations.
Okay, I don't know if we can turn to Spanish or.
Sí, está bien.
Ah, muy bien.
Muchas gracias.
Nos podemos cambiar.
Voy a tomar una foto de ustedes.
Perfecto.
Y bueno, mucha suerte.
Muchas gracias por la oportunidad de aquí y por su tiempo.
No, al contrario. Y bueno,
gracias a los jueces por su tiempo.
Los dejamos a los jueces para que puedan hacer sus deliberaciones y cuando ellos estén listos podrán salir de la sala para pues para anunciar los resultados del equipo.
Perfecto. Entonces el objetivo sería quedarnos todos en la sesión para ya al final.
Sí, en
tener el
unos
anuncio.
minutos más. Sí, entonces
Excelente.
ahorita les tomo una foto a
Sí.
todos. Listo.
Muy bien, pues muchísimas gracias y ahorita en el cierre de la sesión nos veremos.
Sí, en unos minutos. Allá están todos los demás ahí esperándolos.
Excelente, gracias.
Nada, hasta luego.
Bueno, me despido yo también para dejarlos deliberar. Gracias por el
Omar.
tiempo. Ahorita los vemos por allá.
Gracias, Omar.
Yo también me voy a salir para dejarlos deliberar.
¿Y qué hacemos, Guille?
Solo salen, les van a pedir que salir de la sala y ya, salir de la sala se pueden salir ustedes así. Aquí tienen un botoncito azul que dice salir de la sala. Nada más,
Ya, ok.
¿sí?
Ya.
Ok, allá los veo.
Sale, Guille. Gracias.
Muchas gracias.
No, pues gracias a todos. Yo también quiero dar unas breves palabras y van a ser casi comercial. En primer lugar, me sumo mucho al comentario de Raúl. Una de las cosas que más me motiva para dirigir esta competencia es ver la calidad de análisis que pueden hacer pues ustedes, ¿no? Los chicos que están hoy en día en la universidad. Siempre digo, no es que haya salido hace 1000 años de la escuela, pero todos ustedes hacen mucho mejor trabajo de lo que yo pude haber hecho probablemente cuando estaba en la universidad como ustedes. La verdad es que el primer mensaje de mí para ustedes es la admiración por la capacidad para poder hacer ese trabajo de tanta calidad en un tiempo limitado y después organizar presentaciones de primer nivel. No dejo de decir y puedo afirmarlo habiendo conocido gente de todo el mundo, tenemos financieros de primer lugar. Tenemos que sumarnos a la misión de robustecer y desarrollar los mercados financieros en México. Y bueno, entre otras medidas, pues porque sabemos que es